we're entering the third quarter with a real loss of economic momentum. So we're really not seeing a dynamic labor market anymore. And we know this. We know this from other statistics that hiring has slowed. The tariff headwinds, should we say, they're going to take a bite out of household income over the next few months. We're going to see inflation looking much higher. You're going to have inflation creeping higher and higher and higher. And it's going to look like a stagflationary environment.
A 26% discount to SuperMacro is available now to Monetary Matters listeners. Click the link in the description. I'm joined today by Jonny Matthews of SuperMacro. Jonny is a veteran macro trader and analyst, having been a portfolio manager at many years at institutional shops like Brevan Howard. Jonny, it is great to see you. Welcome to Monetary Matters.
Thank you, Jack. It's great to be back on the show.
What we've got today is something that's very rare, because I think I and a lot of people who are not, experienced macro traders, they think that the way you make money in macro is having a firm view. You have a thesis, you kind of, come down from the mountaintop with the tablets, and then you just ride that thesis and you're right off to the sunset. But, as you know, with macro, you're always changing your mind, and it's about trading and implementing it and being able to change your mind. And it's my understanding, Jonny, that you recently have had a little bit of a change in your view of the economy. So as we record here in early August, just am I right? What was your macro view? What is your evolving view? And what occasioned the change?
Well, first of all, for a long time, I've said we would avoid a recession. These signals that people were using to claim that we were due an imminent recession, the yield curve inversion, then the yield curve disinverted. So that was the sign of a recession. Then it was the Psalm rule. You remember, all these things, they come and go. But realistically, throughout that whole period, for the past 3.5 years, I've said there's no sign of a recession on the horizon. And even when the tariffs were introduced, I was of the opinion it wouldn't cause an economic earthquake. But what I have to say is that the disruption to business confidence caused by the imposition of these really sky-high tariffs, then the rollback of those reciprocal tariff rates, and then the reintroduction of very high tariffs, so that the business uncertainty caused a pullback in hiring and capex by businesses. It's also created quite a significant dent to consumer confidence. And what we've seen now is that job growth has really slowed a great deal. Household income growth has slowed. Consumer spending has virtually stalled. And the economy has transformed itself from being a 3% growth rate economy throughout 2023 and 2024. This year so far, we've stepped down to over the first 2 quarters, the average growth rate was 1.2%. And I do believe that going forward, the mix of fiscal policy and just the fact that household income growth, wage growth is now real wage growth has slowed a great deal. We're not going to see the same pace of we're entering the third quarter with a real loss of economic momentum. And I think we're sort of 0 to 1% growth for the rest of this year.
And what is the data that's leading you to make this view? I know a week ago we got a GDP report that was kind of artificially good because net exports was less negative, in the same way that the first quarter GDP report was artificially bad. But what else? We had the jobs report where we had a very a weak reading and then a strong negative revision. We had basically 250,000 jobs that were recorded in May and June that were elided out, that basically they were rated negative. So 258,000 fewer jobs were created in May and June than were previously reported.
Absolutely. Yeah. That job revision was enormous. I don't recall seeing job revisions of that size. I think June jobs were revised down from 144,000 to 19,000, and May jobs from 100 and whatever they were down to also the mid-teens. And of course, Trump
Yeah.
the normal reaction, fire the head of the Bureau of Labor Statistics, blame someone else, always looking for a scapegoat. But in fact, what the reason there are such steep revisions is that the response rate, to the initial payroll survey, has been declining for the last 15 years. It's gone down and down and down. And the only reason why I think the revisions have typically been negative, the only reason that I can come up with is that the companies that are really struggling, they've got bigger problems to face at the moment. The ones that are really struggling put in their responses to the payroll survey way beyond the initial response. So the initial response that the Labour Department gets, they take those. I think it's the response is down to 60% or so now, and then they just assume that the others are at the same rate. But the ones that are reporting later are the companies that are struggling, and they have much lower job growth than the rest of the pack. And so we've had these steep down revisions. I mean, if you look over the last 18 months or so, the revisions have typically been downward to the initial print on the payrolls. It's just the last May and June payroll prints were revised down an enormous amount, as you said, 258,000. And so we had a July payroll print that was okay, 73,000 total jobs, but there's a lack of trust in that figure now because of such steep revisions. And the way that you get economic growth is through income growth, and that requires wages growing faster than inflation and the number of people employed growing. And we don't have either of those now. The job growth has slowed a great deal. Pay growth, I think it was 3.9%, but we have inflation picking up as a result of the tariffs. So, the household income is under a lot of pressure now. The other piece of data that we had last week that I am quite concerned about is consumer spending. So I think I've got a couple of charts. If you look at chart 3 in the slide deck, and here I'm showing payroll growth. Payroll growth over the last 3 months was 35,000 a month. But importantly, the jobs were all created in non-cyclical sectors. So that's government, education, and healthcare. Cyclical sectors, which is everything else, it's manufacturing, financial activities, leisure and hospitality, everything else. Those sectors have shed 49,000 jobs over the last 3 months. So we're really not seeing a dynamic labor market anymore. And we know this. We know this from other statistics that hiring has slowed. It just so happens that companies are not firing people at the moment. The rate of firing is really, really low, but there's not much hiring going on either.
And so, Jonny, we'll put that chart up now. I assume this is after the revision, so a very weak May job number, a very weak June job number, July week as well. You said 73,000, and again in May and June, those eked out gains were all in non-cyclical sectors like government, education, and healthcare. And so, Jonny, is it fair to say that the 30 to 40,000 average over the past 3 months, is that below the replacement rate? Because you think, okay, if the economy is going to add 0 jobs, it has to add 0 jobs. But actually, in order to tread water, you still have to add 40, 50,000 jobs per month. What is the break-even rate because of firings and other reasons, right? Tread water.
Yeah, I think what you're talking about is to hold the unemployment rate
right, exactly,
constant. Yeah. So the unemployment rate from the household survey in the most recent report was 4.248%, narrowly rounded down to 4.2. It could easily have gone to 4.3 from 4.1%. So you need to create a certain amount of jobs each month to keep the unemployment rate stable because the labor force expands. And I think this was the point that Powell was making, because we have much slower immigration now. I don't remember the numbers off the top of my head, but the number of either documented or undocumented immigrants coming into the country has really fallen off a cliff. So you don't have the labor supply from immigration anymore, and that's that's really restricted the growth in the labor supply. So there is a much lower break-even rate of the number of jobs you have to create each month to balance that out with the supply of labor, the supply of new entrants to the labor market. But estimates that I've seen have been around the sort of 70,000 mark to hold the unemployment rate constant. So that's Powell's point that the unemployment rate is stable. We don't have to worry about things. We don't need to create as many jobs per month. But the point is, if you're not creating new jobs, total economy income is not really growing by that much. You need more people working, and you need productivity gains to get economic growth. So yeah, we've got reasonable productivity growth, but if you don't have growth in the labor force and the number of people employed, you are going to have much slower economic growth. And I think the fiscal headwinds, well, the tariff headwinds, should we say, are going to they're going to take a bite out of household income over the next few months. We're going to see inflation looking much higher. These tariffs will have an impact, not just like a one-off hit to the price level, because tariffs will be introduced. Tariffs will feed through the supply chain bit by bit. So you will see each month more and more price increases, and it will look like inflation is just going up and up and up. It's not like all of a sudden overnight all the prices adjust. The prices will adjust slowly. So you will have the impression of inflation moving higher and higher. And I think for households, it's inflation expectations will move higher. I think it'll have quite a detrimental impact. The other interesting thing from last week's data that has caused me to revise my view of how strong the economy is consumption growth. And if we can put up chart 5, you can see that if you look on a month-to-month basis, and I've color-coded them by quarter. So the most recent quarter, April, May, and June, this is real personal consumption expenditures, were at about the same level as in March, kind of flatlining. But because January and February, it was so weak then, the average over the quarter, I think consumption growth over Q2 was 1.4%. But, if it's flatlining like this, it's going to be close to zero in Q3. You're going to have zero consumption growth in Q3. June household real consumption was actually lower than December.
Isn't that somewhat not as bad as it sounds, because in December there's Christmas and not.
Oh,
people,
this is seasonally adjusted.
Okay, never mind. Sorry.
Yeah. So you had a run up towards the end of last year, a lot of tariff front running and everything, a pullback in January and February, and a bounce back. But in reality, if you look at the monthly seasonally adjusted rate of spending, it's gone nowhere since December. And that is, if you think personal consumption, it's 70% of the economy. And it's just kind of flatlining, really.
Consumption is flatlining. Really, I thought that there was a lot of acceleration in maybe April and to a lesser degree May of people buying cars and iPhones in order to front run the tariffs. And also, yeah, I wasn't aware that consumption data was this negative. And this is from the GDP report, right? Or no?
Well, you get the quarterly numbers from the GDP report.
Yeah.
So in this chart, I'm showing the monthly numbers that we get in the personal income and spending report each month. The dotted line, this horizontal line across those bars, is the average for the quarter. And if you kind of eyeball the purple bars, you can see the horizontal line. It's kind of the average of those. Then the light blue bars following those in Q1, it's a little bit higher in Q2. But this is just a statistical anomaly just because of the distribution of those increases. In reality, now it is just flatlining. Has just been flatlining from March. And if it continues on this trajectory, Q3 consumption growth it's going to be close to zero.
Really? And it was growing at what, 3% in real
Well, it
terms?
was, yeah, well, 1.4% in Q2, just the way the statistics work out. But throughout last year, it was growing at about 3%.
Right. And this entire economic cycle from 2020 has been driven from the consumer. And one of my favorite charts is just to look at, I guess, this chart, personal consumption expenditure from, you can start from 2000, you can start from 2010, but just not even the rate of change, but just the every figure. And it's just so clear how above trend US consumption is. Like, we have been consuming more than you would have thought we would if you just had drawn a line in 2019 and drawn a line, the best trend line. And so this economic cycle, do you think consumption is no longer going to be powering this economic cycle? And I guess maybe there are other things, but like three things I think that could power an economic cycle: there's income growth, there's credit growth, and then there's like business investment growth. I think we actually have seen a pickup in business investment growth, right? In terms of capital expenditures with AI and all these hugely capitalized companies just spending billions, hundreds of billions of dollars on AI and stuff. But so you think personal income growth is slower? I guess that leaves credit growth. But yeah, what is going to power this economic cycle higher? Uh, and then if it's not, how are you thinking about the R word, recession?
I'm not predicting a recession at this stage of the game. I think let's just wind it back a little bit. What we had, in fact, what we've had since the financial crisis is a massive wealth transfer from the public sector to the private sector. After the financial crisis, massive bailout of the banks, um, you know, the Fed buying up all the mortgage-backed securities and so on, and debt to GDP jumped from 40% to whatever it was, 70% or whatever it was after the financial crisis. Then we had the pandemic, another massive transfer of wealth from the public sector to the private sector. You had the stimulus checks and all the other income support that went to households. So you now have debt to GDP, government debt to GDP, north of 100%. And since the pandemic, households have built up a massive stockpile of excess savings. That has mostly been exhausted. I'm talking about the excess savings. That's mostly been exhausted. The government has been running with 6% fiscal deficits. Now that when you first increase the deficit, that provides a stimulus, but now it's kind of flattened off at 6%. The big beautiful bill is, I think it provides a small fiscal impulse for next year, but that'll be offset by the impact of the tariffs. So I think, the consumer that has had these massive tailwinds over the last few years that have come to an end. The other factor was that job growth was extremely strong after the pandemic. You had a lot of people getting whose income went up by a very fast rate, and it was hard to hire people. It was very hard for companies to hire people without increasing pay. So pay growth was very high, faster than inflation for a lot of the time. That's all come to an end now. I agree. I agree with you that maybe an expansion of credit could get the economy going again, but I think it's going to be a sluggish third and fourth quarter. And what concerns me with this is that the equity market is poised for continued very strong growth.
I really like the framework that you said. So I kind of asked in a simplistic way, and if you're in the media, you kind of sometimes have to be a little bit simplistic. But it's okay. So if we're not going to have a powerful expansion, then there's going to be a recession. But you said, well, it doesn't have to be a recession. We can kind of just muddle through, have sluggish growth. So what does 0.2% real growth, 0.5%, 0.9%, 1.0% real growth, kind of a sluggish growth environment? What does that environment look like, and do it mean for markets? Because if you have a powerful expansion, obviously stocks are going to outperform bonds drastically. If you have a huge recession, obviously bonds are going to be better than stocks. But what about this kind of sluggish, muddle through, middling area? How do you kind of trade that? How do you think about that?
Well, I agree with you. People do like to be quite binary. It's either full on, we're going gangbusters, or we're heading into a recession. But there can be this muddle through economy, as there was after the the tech bubble burst in 2000. It wasn't really much of a recession after that. I think actually it may not have even been 2 consecutive quarters of negative GDP growth after everything was revised. I think it was really more of a muddle through economy. So I think we could be going into a period like that. And what does it mean for markets? Well, you got the S&P trading on a very, very high multiple. It's priced for 10% earnings growth year after year. And I'm not sure we can get that in an economy that's just growing between 0 and 1%. I don't think that's sustainable. So I'm quite negative now on US equities. But for the fixed income markets, it's quite difficult. We're going to have a much more dovish Fed from next year. We have the early departure of Adriana Kugler. She will be replaced with a massive, outright, make no question about it, a super dove who could subsequently become the next chairman or chairwoman. Plus, Powell, I suspect, will not stay on as a governor. He is entitled to when he finishes being the Fed chair, he can stay on as a governor, but I suspect he may well quit. And then there'll be a vacancy for another governor on the board. So the composition of the Fed is turning much more dovish. However, and this is the tricky thing, the way I'm looking at the fixed income markets, we know that the Fed will start lining up rate cuts once if the labor market really cracks. I think that the Fed will start cutting quite aggressively. But I am concerned that the long end of the yield curve, will be uncomfortable with inflation rising further and further above target, particularly while the US is running such big fiscal deficits. It's not a great mix for the long end of the curve. And so I'm not sure exactly how this is going to play out, but I do think it's worth being prepared for another sell-off in the fixed income markets, after next week's CPI print. To me, it doesn't look like inflation is heading lower. It's certainly not. There is a core, stable level of services inflation. I think in the most recent PCE inflation report, services inflation was something like 3.4%. It's been fairly stable around that level. And now we have the signals that inflation is picking up again as the tariffs start to feed through the supply chain. So we have goods inflation that was negative, over the last 18 months or so. It was a drag on headline inflation, a drag on core inflation. It's now about to turn positive, and more meaningfully positive. I think I've got a chart of PCE inflation that you can, if you look at that, you can see fairly stable services inflation over the last 3 or 4 months. Durable goods providing a drag. And this is core inflation, by the way. Durable goods providing a drag on core inflation. That's about to go into reverse. We have the CPI inflation print next week, and I think we'll see the first signs, not the first signs, more meaningful signs of this in the CPI print next week. Just one other chart while we're on the topic of inflation, and that is the yesterday's ISM services report, which was pretty soft. It was surprisingly soft. But the one bit that was quite firm was the ISM services prices. And on this chart, I'm showing the ISM services prices index leading by 3 months. And CPI inflation, it's not a perfect predictor. You're never going to find something that's a perfect predictor with a 3 month lead. But it shows that, you need to be wary of what's happening with CPI inflation.
So that previous chart showing the contributions to PCE inflation and durable goods was actually showing deflation. So that green bar is a negative, but it actually is turning positive once again. That's interesting. Jonny, I want to go back. You talked about the Fed chair composition and how, first of all, John, you and I have been in contact over the past few weeks, and you talk Kugler, she's going to leave, she's likely going to leave, there's going to be a dub, and then literally she actually resigned. So good call on that. And you think Fed Chair Powell, in the spring of next year, he's not going to be the Fed chair, but he actually could cease to be the Fed governor. So you've got a table showing the current Federal Open Market Committee composition with the Bloomberg rankings from -2 to +2 from dovish to hawkish, and then you show a likely 2026 composition without Kugler and perhaps without Powell as well, showing that it actually is going to be a lot more dovish, right? So does that lead you to be bullish on the 2-year note, the 3-year note, which is going to price in more Fed fund cuts? And yeah, tell us more how you're thinking about the shorter end of the curve. After the Fed meeting last week, I believe, seen as a pretty hawkish meeting, these odds of a September cut were priced at only 40%. Now it's a near certainty, 91% according to the CME. Are you in team cut? Are you with the bond market? And is October, December? Do you think we're going to get these consecutive boom, boom, boom cuts? We understand you're concerned about the long end going up, but what about the 2-year going down?
Okay, well let's first talk about this chart. I took the Bloomberg rankings, and they have since changed. Actually, the Powell, and I was surprised. The Bloomberg guys ranked him as a -1. That's slightly dovish. He's since been changed to a 0, so I need to update this a little bit. But either way, he's going to be gone. And you're going to have a very, very, if he leaves the Fed board, you're going to have a very dovish person in his place. And the point about this chart is to show that there are 7 board members who get a permanent vote on the FOMC committee. And the other 5 guys are the regional Fed presidents, head of the New York Fed, and then it rotates. The composition will change quite a lot next year. There'll be, certainly 3 hawks among the regional Fed presidents, but the composition of the board will be very dovish. You can be fairly sure about that. So coming back to your question, do I think the Fed will cut in September, October, December? I think it's quite likely. But the problem is, the market has already moved a great deal, as you said, from pricing the September cut with a 40% implied probability to 90%. So that's kind of priced in. And I think that, I like, from a trading perspective, it's fine to have, big ideas, but you've got to look at what is the likely payoff. What's the payoff from that idea? And I think this change kind of came out the blue, really. It was the change in the probability for the September rate cut came straight after the payroll print. And now where we are, I think they will cut, but I think the market is vulnerable to a nasty CPI print next week. It's already pricing in, as you said, 90% of a rate cut. So, if you want to bet against that, you're going to get a better payoff by, shorting SOFR futures or the 2-year note, or however you want to do it. There isn't the risk reward doesn't stack up for going outright long of short-term interest rate futures now. Not now. But then, when it comes to the long end, I think the Fed typically, when the labor market data and the inflation data are in conflict, the Fed will favor the labor market data. If the labor data really weakens, it means the economy is going to slow. Inflation will take care of itself in a slowing economy. There's one way to really get rid of inflation is to put the economy into a recession, and it goes. So the Fed will be more proactive if the labor market shows further signs of weakness. But if, this is why the long end of the curve, I think, is vulnerable, because if inflation is still high and the fiscal deficits are still wide, and certainly if unemployment starts to pick up, the fiscal deficits will get a lot worse. And that is quite negative for the long end of the curve. So I think perhaps the best risk reward is from being short the long end. I mean, it's such a consensus trade to just have on a curve steepening trade. Betting on the spread between 10-year and 2-year bonds, bond yields widening out. Very consensus at the moment. But for me, I do think the long end of the curve is vulnerable, and perhaps rather than trying to do these some kind of complicated relative value trade in forward space, better off to just be outright short the long end of the curve.
And do you have that trade on now, or are you looking to do it?
Yeah, I've just put on a small trade in a put spread on the 10-year treasuries. This is very simple. You can look at the payoff ratio. This will expire Friday a week after the CPI print. The price I put it on potentially pay me out something like 8-1 or something for a decline in the price of the 10-year note futures by a full point. A point and a bit would pay me out 8-1. So that's the way I see it. That's the way I see it. The long end is vulnerable now to this kind of this stagflationary risk, where we have an economic slowdown, but inflation picking up and fiscal deficits widening.
Mm-hmm. You think stagflation risk is real in here? Because people talked about stagflation risk 2 years ago, and it was like the least stagflationary environment ever. Real growth was just so high.
Look, I when I say it will look like that. I'm not saying it. That's the kind of environment we're going to be in. It's just going to look like that. These tariffs, as they start feeding through, it's like I said, it's going to be month after month. You're going to have inflation creeping higher and higher and higher, and it's going to look like a stagflationary environment. But as we've discussed previously, these tariffs, they will raise the price level. And then after that, in a year's time, you've got a higher base. It doesn't mean to say inflation will continue to stay high. But the market, the market can't really. I don't think the market will be able to see through this once the impact of the tariffs starts to show up on the inflation prints. I just don't think the market has the capacity to look through that kind of short-term impact and say, well, it's going to be okay in a year or so's time. This is just a one-off price level impact, and inflation will be fine in 2 or 3 years' time.
Johnny, these charts that we've been showing up, this is from your research service, SuperMacro. You write a daily note just to help you trade, and you started to share it with banks and other hedge funds, and people, Monetary Matters listeners, can get 26% discount by clicking the link in the description if they act now. Johnny, we're going to put up a chart of the market implied 3-month rate. So these are the SOFR futures you talked about, not the September rate, but in red we've got the December 2025 SOFR future implying a 3.75% rate, and then in 2026 implying a 3.00 rate. How are you thinking about these rates? Are you more inclined to be long or short both of them, and why?
Well, okay, let me just explain what's going on here. As you said, it's the December 2025 rate is the red line, and the blue line's DEC 2026, and they were both moving in tandem, meaning that the market was not originally expecting many more rate cuts after the end of this year. All the rate cuts were supposed to happen this year, and then we'd be at a rate of perhaps 3.25 to 3.5, and then stay there. But what has happened since April, since the tariff announcements, was that the rate cuts were removed. The 4 rate cuts that were priced at that time have been scaled back to 2, or now it's like 2 and maybe 2.5. But those rate cuts have been pushed into next year. That's how to look at this chart. So, for me, I do think the rate cuts will take place next year. But I think perhaps expecting too much from this year could be a mistake. I really do. I just think the market has priced in so much now Not as much as we had in April, but then there was a long time to go from April to December. Now, we've only got 3 more meetings. We've got September, October, and December. So, I mean, the Fed could do what they did last year and do a 50 basis point cut in September, but I really don't think, they could do that if the labor market completely collapses. But I don't think that's what they're going to do. I think the Fed, and especially with Powell at the helm, will continue to take a very cautious approach to this. And Neil Kashkari, head of the Minneapolis Fed, he spoke earlier today, and he said that perhaps we should. He's not a voting member at the moment, but he will be next year, and he's one of the hawks. But he said, and I kind of agree with him, perhaps we should do a cut now and then pause, to see how things play out. So I think that is how I think the Fed will take a cautious approach to this. I think the Fed sees what they did last year, the 50 basis point cut in September. It caused the long end of the curve to really sell off aggressively. And they did it because we had a soft patch in the employment data at the time. And straight after they cut by 50 basis points, and it wasn't to do with their cut, but somehow everything changed around. We had some very, very strong employment reports, and the economy carried on growing at 3% annualized. And I think perhaps to some extent at the time, they may have regretted responding so hastily with a 50 basis point cut. So I think they'll be a bit more cautious this time, especially with these offsetting dynamics at play, where you have prices that are going to be going up quite fast, and the labour market's still cooling. I think they need to proceed cautiously, and that's what they're going to do.
So that's the bond market. How are you thinking about the stock market? You said you were inclined to be bearish, but are you actually going to be shorting the stock market, buying put spreads?
Yeah.
How are you define this?
Yes, I am now. I mean, I've been hesitant to really get super bearish about the market simply because it's been like standing in the way of a freight train for the last few years. It's just been wrong. And we have had good earnings growth. We have had strong economic growth, and we have had high productivity. We have had very high margins in the equity market. I mean, if you look at the whole economy, the corporate profit share of GDP is as high as it's been in decades. It is very, very high. Company margins are very, very high. That's how it's been for the last few years, but I'm not sure that is going to be sustainable going forward. As I said, economic growth is going to step down from a 3% pace to a more like a 1% pace. And I think corporates will absorb some of the tariff impact into their margins. So I just can't see earnings growth sustaining the same pace that it has done for the last few years. Q2 earnings growth is on track for 10 or 11%. I'm not sure that's going to be the case for Q3. And of course, we've had some big disappointments so far this quarter, but on the whole, it's been okay. In aggregate, it's been okay. I just can't see that being sustained in the current quarter.
Yeah, I'd say the earnings growth from the Magnificent Seven, with a few exceptions, has been pretty remarkable. It seems like just this demand for AI cloud is really been powering. But I mean, that AI cloud is not. It is not the economy. What is even your read of earnings?
I'll take a prime example. Another example. If you go to chart 6, it's another form of high frequency data that I do look at. So if you look at TSA passenger numbers, these are the TSA checkpoints at all the US airports. Passenger numbers were growing. If you look at 2023, there's the normal seasonality, but 2023, a step up from 2022, and the same in 2024, big step up from 2023. 2025, you're just not seeing any real growth in passenger numbers. It's just another example of where consumer spending growth has kind of stalled now. It's kind of flatlining. If you look at some of the companies that do depend on imported goods, like household furnishing companies like Restoration Hardware or any of these kind of companies, they are really being hit quite hard. The Magnificent Seven, of course, you know, they're expanding through the expansion in data center and increased data center use and adoption of AI and all these great things and all this increased investment spending in tech. But I'm not sure how sustainable that is if you don't have real economic growth as well.
Right. And I guess a criticism I've heard from the likes of Jim Chanos and others is that a lot of these capital expenditures, they widen the depreciation schedule. So really, if the useful life is 5 years, you should be taking a 20% depreciation expense every single year, but they're widening it to like 10 years or 12 years. So the depreciation is lower. I don't know what to think of that. Okay, so Johnny, how do you trade that? Because you can have a thesis, okay, this AI thing, it could be getting a little overhyped. The stock market is growing a lot faster than the economy. I mean, that's just objectively true. But is there anything actionable there? You referenced put spreads earlier because I mean it's just so hard to be bearish the market. I mean the momentum in this market is just somewhat unbelievable. But I'm glad that you're finally expressing a bearish view because we haven't had a bearish view on monetary matters in at least a month, I'd say. How are you thinking about trading it?
Well, I think you've got to, obviously the timing is everything. And, we spoke a couple of weeks ago and I said I'd piled on a lot of strangles on the S&P 500 because, first of all, implied volatility at the time was incredibly, incredibly low. And secondly, we had just an enormous amount of event risk from corporate earnings, from economic data, everything that was packed into last week. There was an enormous amount of event risk that just wasn't reflected in the price of S&P options. So it was more a question of saying, okay, I'm willing to risk a small amount of my capital, maybe 20 basis points in the trade that would benefit if the S&P, moved significantly from where it was. And as it happens, it waited till the end of last week and then it did make a half decent move. You can't, I often read guys who say, "Oh, well, this is the top of the market. You've got to be super bearish. This is it. It's all over." But you just can't do that. You've got to kind of try and pick your moment and say, "Well, okay, I really think equities are going to struggle here," which is my opinion. It needs a catalyst, though. It needs a catalyst. And I can't risk too much capital. I can't just say, okay, I'm going to be outright short. The whole of my capital is going to go on an outright short position in the S&P, and I'm going to hold it until I'm proved right. You'll just get carted out by doing that. You just got to say, okay, I'm willing to spend X amount on either puts or put spreads. If the implied volatility, if the options are really cheap, you can do it in outright options. If it's not that cheap, you've got to look at put spreads. You've got to look at a structure where you can say, the most important thing is you want to be able to say, I can hold on to this. It doesn't matter if I'm wrong. I don't have to start panicking. I know what my downside is. It's a controlled risk. I know what the upside is. If the market carries on rallying, I don't have to start thinking about cutting the position. I'm just going to spend X amount on a put or a put spread, and I'm going to sit with it. And it's as simple as that. Trying to be too clever or doing relative value trades, saying, for example, okay, well, I think, perhaps I think that's it for the tech sector. I'm going to be short tech and long value stocks or small caps or whatever. That's too complicated for me. Anyway, that's far too complicated for me.
And if it's too complicated for you, former Brevan Howard portfolio manager who was at Brevan Howard for a long time, by the way, a lot of people who like at Brevan Howard for 1 to 2 years, but people who were there for a very long time is a very, very small number. And you are one of them. I'd also add, Johnny, that you are trying to add alpha, macro alpha, currently in your personal portfolio, and you are, managing a portfolio as well for another company, perhaps you can mention, but that you are a diversifier to other strategies which are long the stock market and long beta. So, this, like, trying to just like always do these sneaky little macro trades by itself maybe isn't the best strategy, but it's a complement to a strategy that is like long stuff as well. So, we definitely recommend, like, here on Monetary Matters, that people, their equity exposure should definitely be greater than zero at an average time. And, like, if they're young like me, it should probably be like close to 100%. Obviously, if they're like 60 or 70, it could be, lower, sometimes way lower, depending on the situation. What about, so if implied volatility, so you're bearish on the market, implied volatility is low, okay, puts, great. What about calls? Because if implied volatility is cheap, calls are cheap as well, I guess, relative to realized. And then also, yeah, what about relative to realized? Because you said, okay, I'm looking at the VIX now, just above 16, which is a 1% move every day pricing in. But that is the S&P has been moving by way less than 1% every day. I think there was like 20 days in a row when it actually didn't have a 1% move. And yet up today, it's up 36 basis points so far as we record, close to 11 a.m. And so what about calls?
All right, let's wind it back a bit. Yes, I also manage a small amount of capital for Fortum Capital. It's a fund. Primarily, most of the assets are run with a long beta exposure. I am part of a diversifier fund. That's how it's supposed to be. So my objective is to try and add alpha, not by not just being long the market the whole time. You're right. You're absolutely right. Generating alpha is extremely difficult. And for most investors, you just want to be long beta to the market and just not worry about it. But throughout my time at Brevan Howard, I found that a lot of the time, doing a lot of small trades, risking a small amount of capital, and then eventually there is one big trade that is so obvious and so apparent, you have to get on it in really big size. I don't have that opinion right now. I'm not seeing something that is really, really massive and compelling. One of the tricks to staying alive and surviving 14 years at a fund like Brevan Howard is to avoid big losses. That's the key thing. There'll always be opportunities to make money, but you've got to be able to avoid big drawdowns. So you have to be able to size the trade in accordance with the environment that we're in. We're trying to add alpha, and there are times when it becomes absolutely screamingly obvious what the right trade is, not only with hindsight, but at the time. But those occasions crop up once or twice a year. So you've got to be careful, you've got to be patient, and you mustn't risk too much capital. Now, coming back to one of the things that you said, calls, is there a rationale for being long calls? One of the things that I can tell you about call options, it's very hard to make money being just outright long calls, because typically what happens is, let's say you're smart enough to buy some calls just after the market takes a dive. At that time, implied volatility will be high. You buy the calls, and then the market recovers, and implied volatility gets just destroyed as the market recovers.
So the option will be worth less. Yeah.
Well, what tends to happen in that situation is, the market goes up, and you'll look at your call option and find that it's hardly gone up in value at all. Until you get through the strike, and assuming you've bought an out the money call with a month or two to expiry, it, as the market takes its time to get closer and closer to the strike, implied volatility goes down and down. You've got the time decay. Everything is working against you, apart from the market moving up and up and up, but it's not enough to really make the call option, rapidly increase in value. It's very hard to make money from just buying outright calls. The opposite is true with puts, because typically when the market goes down, it goes down very fast. But you've got to get the timing right. If implied volatility is super, super high when you buy those puts, it just may not make sense to buy the puts. You're better off to just have a small amount of short delta and a stop on the trade than buying out the money puts, paying way over the odds and hoping for the best. So it's difficult trading where it's not easy trading with options. It really isn't. You've got to get the timing right, and if you're buying options outright, you really don't want to be overpaying for them, or you've just got no chance of getting a decent payoff.
All right, so you don't want to buy calls after the market crashes, because even if the market rebounds vigorously, like it did in March 2020, like it did in April of this year, and
Well, that's an
summer.
exception. That's
Yeah,
an
yeah, yeah, yeah.
exception.
But even so, you would have made money, but like overall, the implied volatility would have gone down by a lot. So really, you should have been short puts or just long delta, as you say. Okay, but what about now, Johnny, when implied volatility is low? Like, are you really overpaying by buying, a 3 or 6 or 1 year call on the S&P?
Well, I think if we're looking specifically at something fairly long dated, like let's say you have a 3-year call on the S&P, that will have very little convexity. It just has a delta. Let's say the delta is 10 or 20%. That delta won't change. The market will, it's the kind of exposure that you will end up with is not much different to just putting 20% of the capital into the market. The
Yeah.
market goes up 1%, you'll make 20 basis points. Market goes down 1%, you'll lose 20 basis points. It'll be the same with the call. There just isn't the convexity. So there's not much benefit to having it, except that you could say, well, okay, if I have a call, I know exactly what my downside is. It's capped. I'm going to spend X amount of money and hope for the best. But long dated calls, they don't work that well. It's just like having
Yeah.
a small amount of delta.
Yeah, I think especially if you're an institutional trader, they do. I think you're right. I think for like a retail trader who doesn't have access to basically borrowing at very close to the risk-free rate, like they can be capital efficient with margin and stuff. But I can understand from an institutional perspective, you don't get that advantage. Okay, so you don't like calls.
No. I really don't. Look, the way I see the market at the moment is, I think it's going to be very challenging few months now. The economic data are just going to be unpleasant, should we say. You have slowing consumption growth, slowing job growth, very low firings, but very low hirings, inflation picking up, and I think, I think the response from the market is going to be negative for equities, and I'm not sure that at the moment the market is pleased with the fact that we should in theory have a deeper rate cuts next year and this year. But that's not going to be a panacea if earnings growth slows a great deal.
Stagflation summer.
Yeah, it's going to look like a stagflation autumn or fall,
Mhm.
as you call it. Yeah, it is going to look that way. So, yeah, I'm really not constructive over the markets. And I think you really need to keep your powder dry for a really, really good opportunity. At the moment, honestly, I just don't see what is blindingly obvious, like I saw, for example, in 2022 when the obvious trade was to be short fixed income, really, really short. At the moment, I think if anything, you just got to wait and see if the market prices in too many cuts for this year, based on what I think is going to happen to inflation, or prices in at the moment. I think the long end of the fixed income market is vulnerable. I think you need to have a small short in bonds, and I'll strategically try to pick my moment to have some short positions in equities.
Johnny, I'm just going through the super macro note. Again, Monetary Master listeners right now can get 26% off. I'll ask you about, just tell us about the note in general later on, but I'm just seeing the Eurozone industrial production level. Am I reading this chart right that 2015 is indexed to 100 and Germany, the red line? Is industrial production in Germany now like 10% lower than it was in 2015?
Yeah. I mean, it's been a very, very difficult period for the European industrial sector. It really has, since the pandemic, and it's struggling to get back on its feet. But I am quite constructive about the Eurozone economy, and I've said this for a long time. I don't think the ECB will get another rate cut in this cycle, and so and I'll say the you have a governing council on the ECB that make the monetary policy decisions. Obviously, there's there's a representative from each of the Eurozone countries, but the person, the one person you really want to pay attention to over and above all the others is Isabel Schnabel. She's on the executive board, first of all, and she is really the heavyweight. And she is the one who has said the bar for another rate cut is quite high. Lagarde, I'm not sure Lagarde is such a strong, she's more of a consensus builder, but she supports what Schnabel says. Philip Lane is the other one, as the chief economist. You want to pay attention to what he's saying. But to me, I think as far as the ECB is concerned, they've finished with the cutting cycle. The most recent inflation we had was marginally higher than expected. The ECB's projections were for inflation to dip a bit further this year. It was unchanged in the most recent reading. I think the ECB may revise their inflation projections a bit higher, and certainly, the market is still pricing one more cut and then a series of hikes. And I think as far as the ECB is concerned, I don't think they would want to do another cut now only to be reversing it next year. To me, that just doesn't make sense. There's a massive fiscal stimulus coming down the pipeline from Germany. So that should take effect next year. Like I said, inflation doesn't look like it's going to dip in line with their projections. So I think another cut is off the table now. Plus, the unemployment rate in the Eurozone is still at a record low. The labour market has shown incredible resilience. So one of the trades that I do still have on, I've unwound quite a bit of it, is being short the 2-year German bond futures, the Schatz futures, because they are priced for one further ECB cut, and then a period of, the deposit rate being down at 1.75, and then towards the back end of next year, the market is priced for a reversal of that cut for rates to start heading higher. I don't think that's how things will play out. I think the ECB is just finished with cutting for now.
So you think the ECB is finished with cutting? You like shorting the European rates market, although you said you took some of it off. What about European equities? And even though German industrial production, I mean, I knew it was weak. Your chart is so clear just how weak industrial production is in Germany. The German stock market, the DAX, is at all-time highs. So an important reminder that even in Europe, industrial production is not the main driver of profit growth or even the stock market. Just how are you thinking about European equities, across the continent? I know for a time you were long European bank shares, that worked out well, but are you eyeing any position anywhere, in the UK or across the European continent?
First of all, for the European and the UK equity markets, they already trade on very, very low valuations compared to the US. They are the companies that comprise those indices, the big stocks that make up the indices. They're not really that exposed to their domestic economies. I mean, I think something like 90% of the FTSE 100 revenue comes from abroad. These are big, globally diversified international companies that happen to have a listing in London. So, but for the FTSE, trades on a PE of something like 14, and it's full of a lot of old economy type stocks. But they are in pretty good shape. Same for the European economy. I mean, for Europe, my rationale for being long of the banks was that the banks had really struggled with the negative deposit rate for years in the eurozone, and finally we had the ECB hike rates up to 4%. It was a massive boost to net interest margins for the European banks, and that just wasn't reflected in the share prices at the time. They've since, I mean, I had the trade on in pretty big size about a year or so ago, and regressively got out of it. I mean, the banks have just been going up and up and up. There's been nothing stopping them. But to answer your question, yeah, if I had to put on a relative value trade, yes, I would put on a kind of pan-European basket of stocks. There's the stock 600, which covers not just companies that are in the eurozone, but in Switzerland, in the UK, and so on. I would put that on versus the S&P 500, certainly. I still think that's the case. I mean, that trade has done brilliantly this year, partly from the outperformance of the European markets, but also from the currency effect.
Mm-hmm. And you don't have a strong view of the dollar versus the euro?
Well, I think it's very, very hard to I honestly, I to figure out what it is that's driving currencies at the moment. It's very, very difficult. It's not interest rate differentials at the moment. It's not political situation. I mean, the fact that Trump is doing the kind of things that you'd expect from a banana republic, firing the heads of various federal agencies because he doesn't like the statistics they're producing, and threatening to fire the Fed chair and so on. And yet, the dollar stopped going down. It had a sell-off at the start of the year, but that was just a kind of reversal from years of gains. I think occasionally it does make sense to when all the stars aligned to take a view on a currency. But as far as the dollar is concerned, I don't subscribe to this view that the dollar is just going to keep on going down and down and down against every other currency, because most of the other currencies, certainly in the G7 or the G10, have their own issues. Certainly the UK economy has some pretty big issues right now, some massive issues. There was a report out today from the National Institute of Economic and Social Research saying that the Chancellor is still going to fall short of her budget targets and will have to probably raise income tax in the next budget. She already raised the payroll tax in April, and since her decision to increase the payroll tax was announced, the decision was announced last October, total UK payrolls have been declining each month. It's just too big of an expense for companies to bear. So now, the UK hasn't raised the kind of revenue from the payroll tax that was expected, and there are still massive shortfalls in the budget, partly because of slow growth and partly because of higher yields. The Chancellor's now got to find another source of income. So the UK has its own challenges. The Eurozone too. It's like you said, with the industrial production, it's been really, really sluggish. I mean, I'm hopeful that this is the end of the down. We've now reached the end of the downturn in the industrial sector in the Eurozone. It's quite likely that the euro will outperform the dollar, because if the ECB does go on hold and the Fed starts really cutting aggressively, that should help. Plus, I think in the Eurozone, if you look at the household savings rate, it's really, really high, and it crept up. It's just been creeping. It crept up throughout last year. So there's a massive kind of potential amount of pent up consumer demand. total employment is at a record high in the Eurozone. There are plenty of reasons to be quite bullish of the European consumer. Um, and like I said, the fiscal impulse that's coming down the pipelines from Germany is absolutely enormous. Absolutely enormous.
So you're bull on the European economy. Jonny, I'm just going through your super macro note. You got some great stuff on China and Japan. Just tell us about, why did you start writing the super macro note? What does it do for you, for your trading process? And then tell us about what you think it could do for other people as well.
Yeah, first of all, um, I write this note because it clarifies my thinking and it forces me to do a lot of additional research and be able to string my thoughts together in a coherent way and explain the implications of the economic data that we're seeing and what that means for markets. And by writing it down, it really, really forces you to adopt a very clear thought process and try to understand the implications. So that's really why I like to write about what's going on in the markets. Um, I started doing this, and it was primarily for institutional investors at hedge funds and banks and so on. And then a few years ago, I started to make it available to retail investors as well. Um, Let me just make clear: it's not one of those kind of newsletters with 10 stocks that will potentially make you a millionaire in the next 2 weeks. It's not that kind of thing.
Yeah,
Um,
they'll make you a billionaire, not a millionaire.
yeah, that's it, Jack. Thanks. No, I mean, I read a lot of economic research. Read a lot of stuff where I disagree with what the guy's saying, but I want to understand what his thought process is and why he says what he says. And I hope that's what this note gives to the readers. It's a whole load of charts, it's a whole lot of thoughts, a whole lot of explanations for what the economic data really mean. And from that, you may not agree with the kind of trades that I may have on at the time. I do talk about the trades that I'm going to do and the trades that I have on. You may not agree with them, but at least you can understand why I've put them on. And you may think to yourself, well, he's wrong. He's wrong about this because I think perhaps job growth is going to pick up again in Q4 or whatever it is. But at least you've got a framework for deciding on what trades you want to do. And so, that's what it is. And subscribers can take a free trial for 30 days. And, if they like it, run with the subscription.
Right. I really like it. It's my guide to economic data around the world, particularly a lot of coverage around non-US stuff that I don't get much exposure to. And you obviously do share your analysis and your opinion, but it's a lot of research and newsletter is like a lot of opinion and invective without a trade. That's very rare. Like you talk about where you think the risk rewards are, and the potential trade. The trade is very clear. It's extremely actionable, and also at the bottom you have on what are your live positions and your P&L. It's very trackable. So again, Monetary Matters listeners right now can get 26% off. So click the link in the description. Jonny, just on the trades, one thing I noticed is it seems like you have the trades on either in small size or in a very risk controlled way, and I presume that is a habit that you got from Brevan Howard and other an institutional background. So you're always targeting a minimum drawdown, which may make sense if you work at an institutional fund that has all of these netting
No,
positions.
actually, no, Jay. Sorry to interrupt, but
Yeah.
you're actually wrong about that.
Okay.
If you were reading this note 2 or 3 years ago, you'd see. I was short treasuries in a size 5 times the notional of assets under management. It's a big trade. In fact, one is encouraged to really put on trades in big size when, certainly at Brevan Howard we were, when you have a very strong view. And really, you don't want to get caught out by doing the big trades when you don't have a really, really firm view. Um, One of the things I will tell you while I was at Brevan Howard which made it kind of difficult, was we used to have a monthly meeting where you had to come up with 2 trade ideas for the monthly meeting. Everyone had to do this, and you had to present them, but you also had to have them on. And that meant that what would happen is, 3 days before the monthly meeting, you'd suddenly be panicking, thinking, Christ, I've got to think of some trade ideas for this meeting that look sensible. And you put together something and put the trade on and then present it in the meeting. And it wouldn't, it would end up being a fairly low conviction trade because the opportunity just wasn't there. And I think that's the important thing. You got to really, really be patient in this game. So you have to have, at times like this, where there isn't a really what I would call a obvious slam dunk kind of trade, you can only have controlled risk trades on, fairly limited risk trades. You can't really just swing for the fences. The new opportunities will crop up. They always do.
Tell us about how large did you size the 2022 bond short, and what was your, I guess, notional short position relative to total capital? And then in terms of, I don't know if you evaluate risk, which depends on the volatility, but like however you want to define it, how big was your bond short, and what were the returns from that trade?
Oh yeah. So in 2022, I basically shorted bonds in a notional size 5 times my capital. So, and at the time, I think the yield was 122 when I first got in. The yield on the 10-year was 122. And I thought the downside risk, honestly, I really saw very limited downside risk. Sometimes a trade really lines up incredibly well. You can still be wrong. For me, if I was going to be wrong, I was going to lose a chunk of capital. But to me, it was extremely compelling at the time. So yeah, I didn't measure it in terms of value at risk. That's I don't have the tools for that. Besides which, it's not a great indicator of the true risk. But you can, you could see that. I think the low for the 10-year at the time, prior to that, was like 50 basis points, and it was now trading at 122. So you could do a rough estimate and say, well, okay, if we go back to 50 basis points in yield, how much will the bond move, and what does that translate into losses? It would have been a big loss. I wouldn't have stomached that kind of loss. I would have perhaps stomached it for 1 or 2 points on the bond, which is which at the time was perhaps equivalent to 1.5% move on the bond, which would have cost me 5 times that, 7 to 8%.
So you think that 7 to 8% drawdown is like huge, but to a lot of people, it's not huge. But
yeah, that's well, yeah. I mean that is, to me. I mean, in my worst year at Brevan Howard, I lost 4%.
That's crazy.
Yeah, well, and the best years were in the high teens, and I think that is the secret to being able to sustain yourself in this industry, is that you have relatively small drawdowns. And unfortunately, you can go for a long period of kind of trading water or not making a lot of money before the big opportunity arises. And then you can make the high teens. Then you can. But you've got to avoid, I think, you've got to avoid the 30%, 40% drawdowns. Some people are okay with it. Some people are okay with swinging it around and losing 30% one year, making 50% the next year and so on. But it's not, it's not my style of trading. And I don't think that if you're at a respectable large hedge funds, that's the kind of thing that would keep you in a job.
So yeah, the best traders are at the best hedge funds, and I mean, such a multi-decade career with a 4% drawdown being your worst year, that really is impressive. Do you think that the best way to invest is on this drawdown minimization, or is it on maybe return maximization? And as I said, the best traders at the best hedge funds, but are they trading that way? Were you trading that way? Do you trade that way just because the nature of the hedge fund business model is that if you have a big drawdown, your LPs are going to pull the money, and that's what you have to avoid?
Well, it was at the time I was at Brevan Howard. It was slightly worse because we weren't paid out all of our bonus at the end of the year. If we've made money, we got paid 60% of what we were owed. 40% went into a deferred compensation pot, and if we lost money, it came out of that deferred compensation pot. So our own capital was at risk. It was almost like, we were trading our own capital for a lot of the time. So I think some traders turn up at a fund and they think, well, okay, personally, there's no downside risk for me. I'll just swing for the fences. And if I get it right, I really enrich myself. If I get it wrong, I just walk away from the fund. That was never my style. And that is probably why I stayed for so long at Brevan Howard. And I think, you have to be, there was some quote, I wish I'd written it down, something to do with trading being something like 9% research, 1% trading, and 90% waiting, or something along those lines. It really is a question of waiting for the opportunities. That is what's incredibly important. And, by doing the research, by writing, but for me, by writing about everything and analyzing it, that's what really gives me the insights for when the good opportunities will arise.
I think it's kind of like hunting. Like, you always have to be paying attention, walking around, trying to track the prey. But like, you only get that, the chance to make that big shot quite rarely.
That's it. That is it in a nutshell. Yeah.
We'll leave it there. People can find you on Twitter, Jonny, at super_macro. Again, 26% discount is available now to Monetary Matters listeners by clicking the link in the description. Leave a rating and review for Monetary Matters on Apple Podcasts or Spotify. It really helps the show. And also subscribe to the Monetary Matters YouTube channel. Until next time.
Thanks, Jack.
Thank you. Just close the door.